Look, a downgrade from AAA would affect the banks materially. So there's the ratings agencies invoke what's called the sovereign ceiling, and anything that sits under that ceiling and has some implicit or external or explicit guarantee through to that AAA rating is immediately affected. So we would expect the banks to be downgraded on the back of a sovereign downgrade, and clearly that has large implications for their funding books, which are require international capital to fund about 30% of those loan books, give or take. Again, that's a financial tightening, probably coming at a time when the country's not experiencing robust and wonderful growth. If we're losing our AAA, we're losing it for a good reason, because we're trying to continue to stimulate via running a structural deficit. So we think that those implications for the banking sector are quite powerful, and it would have a material impact on the cost of funding for banks. Again, that would probably be passed through to consumers. Banks are not in the business of absorbing those costs. They do pass them through quickly, and they pass them through as a collective. They would all be affected, so it's easy to do if it's not in isolation. If they're moving as a unit, seemingly it's more stomachable from their marketing departments. But yeah, it has a negative impact, and certainly something that bears watching. I guess it'd also have a big impact on state governments and certainly more infrequent borrowers in that system. Clearly, the East Coast states are the most frequent and the largest borrowers. As we move across the country, that tends to be more illiquid and more infrequent. It could have a real effect on them, because a step down again, makes it harder for them to attract funds, and would blow their funding costs quite substantially. Yeah, look, clearly banks are not in the business of absorbing these kind of cost pressures. They will pass them through. They are struggling in terms of generating net interest margin, and so whether they're putting these slight hikes in or withdrawing teaser products from market or the like, we've seen a number of institutions move now. I guess that leaves us an interesting setup for the RBA, because the RBA's great fear is that they restoke the property market by cutting again. They have been very reluctant to move. We do think that if they do have to move, it'll be at least 50 basis points. They don't have a history of tweaking, so as much as that wouldn't be delivered in one hit, it's probably delivered in 2 by 25. Arguably, would Joe Average notice that in his hip pocket on the weekend? Maybe not. Maybe these out-of-cycle moves are going to push his mortgage rates higher. The RBA will cut and bring that down, but we don't expect the banks would pass that on in full. Certainly the RBNZ cut unexpectedly 3 or 4 weeks ago in New Zealand. Most of those large New Zealand banks are owned by the Aussie banks, and we saw there that they passed on only 10 or 15 of the 25 and used the remainder to rebuild that net interest margin to maintain their margins. So we think that we can get a situation here where the RBA can cut. Probably doesn't restoke the property market to the extent that people would ordinarily expect, but critically it will drive the dollar down, and that's certainly something they've talked about at length. I guess this currency rally is now 13 or 14% off the lows. It's most unwelcome at the RBA because of the way that it tightens financial conditions. It leaves the RBA in a precarious position. We've got inflation data due next week, and that'll be a really critical binary moment for the rate outlook in the near term. The RBA have a hard target of 2 to 3% for that inflation monitoring, and clearly we're going to be knocking on the lower bound of that, which means they're absolutely within their right to cut rates. And so I think, depending on how the employment situation holds up, in a headline sense, employment's been looking okay, but when you lift the lid, not quite as strong as the headline would suggest. There's been a large rise in part-time employment, a bit of a decay in the recent survey in full-time employment, and it's leaving the workforce underemployed, and it's just got a little drag effect on growth.